Welcome to the Encrypted Oracle. Stop right there. What you're about to hear will completely change your perspective on Bitcoin and the global financial market. In 2026, Bitcoin ETFs bought more Bitcoin than every miner on the planet could produce. This is not a mistake. This is not an exaggeration. These are verified on-chain figures reported by Glassnode and Bloomberg Intelligence. Imagine a bakery that produces 100 loaves a day, and suddenly a customer shows up wanting to buy 270 loaves daily. What happens to the price of bread? Exactly. That is precisely what's happening with Bitcoin right now, and most people still have no idea. Before we get into the numbers that are going to blow your mind, you need to understand exactly what a Bitcoin ETF is, because everything in this analysis depends on it. An ETF, or exchange-traded fund, is essentially a financial vehicle that lets anyone buy exposure to Bitcoin through the traditional stock market. No wallet needed, no private keys to manage. BlackRock launched its IBIT, Fidelity has FBTC, ARK Invest has ARKB. When you buy a share of these funds, they are legally required to buy real Bitcoin on the open market. Physical Bitcoin that goes into a cold vault and never comes back out. Every dollar that flows into these ETFs becomes direct demand for real Bitcoin. That is what makes this story so incredibly powerful. Here comes the information that major financial media outlets are not covering with the urgency it deserves. Post the 2024 halving, Bitcoin miners produced 3.125 BTC per block, with one block every 10 minutes. That works out to roughly 164,250 new Bitcoin per semester. Now listen to this, BlackRock's Ciphered alone accumulated over 300,000 Bitcoin in the first half of 2026. Add in Fidelity, ARK, Invesco, Franklin Templeton and the other funds, and we are talking about more than 450,000 BTC absorbed by ETFs in that same period. The math is merciless, less than half of what was demanded was actually produced. Satoshi's program scarcity is executing itself in real. BlackRock, the largest asset management fund on the planet, with over $10 trillion in assets under management. Larry Fink, the same man who called Bitcoin a money laundering index in 2017, publicly declared in 2024 that Bitcoin is digital gold, and since then his IBIT fund has not stopped accumulating. By mid-2026, BlackRock had become the largest institutional Bitcoin holder in the world, surpassing even MicroStrategy. And here is the data point that breaks everything: when BlackRock buys Bitcoin for its ETF, that Bitcoin does not return to the market. It is not sold to take profits in the next cycle. It sits in cold storage, permanently removed from circulation, while new investors keep pause. Take a breath. Because now comes the pattern of thinking that changes everything. Many people believe that when they buy a Bitcoin ETF, they are buying Bitcoin. Technically yes, the fund buys it on their behalf. But there is something deeper here that almost nobody is discussing. According to Glassnode data, 78% of Bitcoin in circulation has not moved in over a year. Long-term holders are not selling. Miners are selling less because the price keeps rising. And now ETFs are vacuuming up available Bitcoin on exchanges like an industrial-grade Hoover. Net flow data on Bitcoin exchanges shows historic withdrawals. Bitcoin is leaving exchanges and heading into institutional vaults at a rate that has no precedent in the entire history of this network. We are witnessing an unparalleled supply compression. Or better, depending on which side you are on. The April 2024 halving cut miner rewards to 3.125 BTC per block overnight, meaning the daily production of new Bitcoin was cut in half in a single day. It was already scarce. After the halving, it became brutally scarce. Historically, halvings have preceded Bitcoin's biggest bull runs. After the 2012 halving, BTC rose 9,000%. After 2016, it rose 2,900%. After 2020, it rose 700%. But none of those halvings occurred while institutional ETFs were simultaneously vacuuming up available supply. This time the scenario is radically different. Supply was cut in half precisely when institutional demand tripled. The laws of supply and demand are brutally simple. This is where the story gets philosophical, and I want you to really think about it. For years, Bitcoin's narrative was, this is the people's money, no banks, no intermediaries, decentralized. And that still holds true at the protocol level. But what is happening in the price market is a different story. Wall Street arrived with its ETFs and is buying Bitcoin that individual small investors simply cannot buy because they lack the capital. So what do you do in this scenario? Option A, buy an ETF and hand your Bitcoin to BlackRock for safekeeping. Option B, buy Bitcoin directly and store it in your own cold wallet, being your own bank. The question you must ask yourself is, do you trust Larry Fink more, or the cryptography behind your 12-word seed phrase? There is no universally correct answer, but you need to be clear on it before you invest. Now I am going to tell you something that many crypto influencers will not tell you because they do not want to scare away newcomers to the market. Bitcoin ETFs have real traps you absolutely need to know about. First, you pay annual management fees ranging from 0.19% to 0.25%. That sounds small, but over decades of compounded accumulation, that is real money you are losing. Second, during extreme market events, the fund can temporarily suspend redemptions. Third, if BlackRock or Fidelity face legal or regulatory problems, your Bitcoin could be frozen for months. Fourth, and this is the big one, with an ETF, you never hold your private keys. Not your keys, not your coin still stands as the golden rule. ETFs are perfect for quick access inside retirement accounts or for investors who want no technical complexity. But for maximum financial sovereignty, a cold wallet still wins every time. This is the million-dollar question. Literally. If ETF demand exceeds mining production by 2.7 times, what should mathematically happen to the price? The answer lies in stock-to-flow, in scarcity models, and in the history of every asset with a fixed supply. When demand structurally outpaces supply, the price finds its new equilibrium at significantly higher levels. Quantitative models from firms like ARK Invest project that if institutional adoption continues at its current pace, Bitcoin could establish new all-time highs that double or triple 2025 levels. But be careful, the Cipher Oracle does not give specific price predictions because nobody can know the future with certainty. What can be said with confidence is this: supply and demand fundamentals have never been more favorable for Bitcoin in its entire 15-year history. Let's summarize everything we analyzed today on the Cipher Oracle into 5 points you cannot forget. 1. Bitcoin ETFs bought over 450,000 BTC in the first half of 2026, while miners produced only 164,250 BTC. 2. BlackRock Ciphered became the largest institutional Bitcoin holder in the world, surpassing MicroStrategy. 3. The 2024 halving cut production in half, amplifying the gap between supply and demand. 4. 78% of Bitcoin has not moved in over a year, signaling that long-term holders are not selling. 5. ETFs are powerful tools but carry real limitations, including management fees, third-party custody, and regulatory risk. With these 5 keys, you now have more context than 95% of investors in the market. The question is, what are you going to do with this information? That answer belongs to you. Here comes the question very few people dare to ask out loud: if BlackRock, Fidelity, and ARK Invest hold more Bitcoin than is mined every year, who actually controls the market now? Bitcoin used to be the asset of everyday people, cypherpunks, those who distrusted the traditional financial system. But in 2026, just 6 Wall Street institutions control approximately 8% of all Bitcoin in circulation. That is more concentration than central banks hold in physical gold. And the most ironic part is that Bitcoin was created precisely to prevent exactly this. Satoshi Nakamoto must be watching all of this from somewhere with a mixture of pride and horror at the very same time. This video is possible thanks to Binance. Compare Bitcoin sin commissions. Link in description. Alright, let's talk about what everyone wants to know: are ETFs actually driving Bitcoin's price up? The short answer is yes, but with important nuances that change the whole picture. When an ETF like BlackRock's receives $1 billion from new investors, its custodian, typically Coinbase custody, goes out and buys real Bitcoin on the open market. That creates immediate buying pressure. In January 2024, the first 10 days of spot ETFs generated over $4.6 billion in net inflows. Bitcoin's price rose 40% during that same period. But watch out, this works in reverse too. When there are massive outflows, as happened in August 2024, the price dropped nearly 20% in a single week. ETFs amplified both the rallies and the sell-offs. Let me give you a concrete example that is going to blow your mind. Imagine that tomorrow morning a pension fund manager in Texas decides to move 2% of his fund into Bitcoin through an ETF. That sounds small, right? That fund has $80 billion in assets. 2% is $1.6 billion. At current prices, that means roughly 16,000 Bitcoins need to be purchased on the open market. To put that in perspective, on a normal day only 450 new Bitcoins are mined worldwide. This manager would need 35 full days of the entire planet's Bitcoin production just to fill his single order. Of course they don't buy it all at once, but that kind of buying pressure, multiplied across dozens of institutional funds, is exactly what is happening in the market every single week in 2026. In 2026, the regulatory landscape for Bitcoin changed radically, and ETFs had everything to do with it. Before the SEC approved spot ETFs in January 2024, Bitcoin lived in a regulatory gray zone. Large institutions could not touch it even if they wanted to. But once the world's most powerful regulator gave its implicit stamp of approval, everything shifted. Now in 2026, we have clear regulation in the United States, Europe with its MiCA framework, and even Japan and Australia launched their own Bitcoin ETFs. That sounds like a good thing, and partly it is because it brings in more capital. But it also means Bitcoin now has rules, mandatory reporting requirements, and is subject to asset freezes if a regulator orders it. That decentralization that was so celebrated is slowly being surrounded by institutional fences. This is the million-dollar question, and I am going to be completely honest with you. It entirely depends on who you are and what you are looking for. If you are a traditional investor who already has a brokerage account, who invests in stocks and index funds, and simply wants exposure to Bitcoin's price without any technical complexity, then an ETF makes absolute sense. No wallet needed, no seed phrase, no worrying about exchange hacks. But if you are someone who believes in Bitcoin's original philosophy, in financial sovereignty, in having real control over your money without depending on third parties, then an ETF is the exact opposite of what Bitcoin represents. Remember the mantra, not your keys, not your coins. With an ETF, BlackRock holds the keys, not you. Both options are valid, but you need to know which one you are choosing and exactly why. There is someone who anticipated exactly this scenario years ago and was completely ignored, then ridiculed, and now it turns out he was right all along. Michael Saylor, the CEO of MicroStrategy, started buying corporate Bitcoin in 2020 when nobody else was doing it. His exact words were, "Institutions are going to come in, they are going to buy everything they can, and those who do not have Bitcoin are going to wish they had bought it sooner." In 2026, MicroStrategy holds over 500,000 Bitcoins on its balance sheet. Its stock rose more than 3,000% since his strategy began. And now the bald round-faced man who was the laughingstock of Wall Street is being studied in finance courses as a visionary. This does not mean you should do exactly what he did. His company had specific resources to weather the downturns. But it does mean it is worth listening to the person who has spent the most time analyzing institutional impact on Bitcoin. Not everything is rosy, and I need to be honest about the real risks that exist in this ecosystem in 2026. First, concentration risk. If the 5 largest ETFs decided to sell simultaneously, the market would collapse in a way we have never seen before. Second, custodian risk. Coinbase custody holds the Bitcoin for the majority of ETFs. If Coinbase faced a serious regulatory or technical problem, it would affect tens of billions in assets. Third, correlation risk. In 2025 we saw that when traditional markets fall hard, ETF investors sell Bitcoin just like they sell stocks, eliminating the supposed benefit of decorrelation. And fourth, regulatory risk. A change of government, a global financial crisis, or a political decision could freeze or force the mass liquidation of these ETFs with very little advance warning. Knowing these risks does not mean you should not invest, it means you should invest with your eyes wide open. If you thought Bitcoin ETFs were big, wait until you see what is coming because this is only just getting started. In 2024, Ethereum spot ETFs were approved, and by 2026 they are already attracting significant institutional capital, though still far behind Bitcoin's levels. But the pattern is identical: more institutional buying than new Ether created, upward price pressure, and a mainstream adoption that Ethereum never had before. On the horizon there is already talk of Solana ETFs, diversified crypto index funds, and even ETFs that combine Bitcoin with shares of related companies. This means that the institutionalization process Bitcoin went through in 2024 and 2025 will repeat itself with other cryptocurrencies. And those who understand the pattern now, those who watched how it worked with Bitcoin, will be in a privileged position to anticipate what is coming with the next wave of assets. Alright, we have reached the end, and I want you to walk away with a full, clear picture. In 2026, Bitcoin ETFs bought more than double the Bitcoin that was mined all year. BlackRock holds over 550,000 Bitcoins worth more than $55 billion. The halving reduced new supply to just 450 Bitcoins per day, while ETFs demand thousands daily. This mathematical pressure between limited supply and growing institutional demand is the most important financial story of this decade. As small investors, we have two paths: ETFs, which are easy but surrender our sovereignty, or self-custodied Bitcoin in a cold wallet, which is more complex but gives us real control. There is no universally correct answer. But there is a correct answer for you, depending on your goals, your risk tolerance, and how much you value financial independence versus convenience. What you cannot do is ignore this revolution that is happening right before your eyes. If you made it this far, you already know more about Bitcoin ETFs than 99% of people out there. And that is real power in the financial market. But this is only one piece of the puzzle. Every week I publish analysis like this, data that mainstream news does not cover, institutional trends before they hit the mainstream, and practical strategies for the everyday investor. Subscribe to the channel right now and hit the bell so you never miss a thing. Also, I want to ask you in the comments, would you rather hold Bitcoin in a BlackRock ETF or in your own cold wallet? There is no wrong answer, I genuinely want to read your reasoning. And if this video delivered real value to you, share it with someone who needs to understand what is happening with the money of the future. Financial knowledge is the most underrated asset that exists, and you just invested in it. See you in the next video. Subscribe to the channel and ring the bell to never miss a video. Every week we publish information that can change your financial future.